Well, welcome to Intermediate Module 4. Here we'll be talking about risk and trade management, position sizing. Position sizing deals with how fast the trade you are handling at that moment, how high it is, like your contract, the contract size you are using. Is it a very big contract size? Are you over risking? Are you risking lesser than you should be risking? Because yes, there's actually something called under risking. I think so, yes. Like, you need to just be risking smartly. You don't need to be doing too much, and you do not need to be doing lesser. So traders adjust position size based on a few things. Here is what fixed percentage. All right, so let's say a trader is handling an account of 5 million naira and is risking 1%. That's 50,000 naira per trade. All right, this keeps consistency. All right. So depending on the stop loss of that particular trade, that will be the only reason why the person will adjust the position size, because the stop loss has to be equivalent to risking only just 1% of the account. So then another one is volatility. So if the stop loss is very wild, distance from stop loss to the entry is very wild, maybe like on gold, right? And the markets will be unstable. So you might want to reduce your risk. Nothing is 100%, and sometimes you still want to be smart with it. Another reason is the setup quality. I think that there's high quality setup, there's low probability setup as well. So if you are about to take a low probability trade and it seems risky, of course, like more risky than the actual risk we're talking about, then you can now reduce your risk percentage as well. So if you're in drawdown and you're feeling like you're diving too deep, so you might also want to also cut your risks down as well. So yeah, we're talking about scaling in. This comes in adding positions, but scaling in is there are two different overview. All right, so let's say an example is that what you're risking 0.5% on your initial entry. All right, so eventually what you add 0.5% on second confirmation, it still exposes you to 1%. So let's say you always say that what you want to risk, what you want to risk 1% per trade. That's what you're always taking yourself. And we say a trade is like a buy or sell. So you can be on a single trade and be holding two positions. So in the sense that so if you reach 0.5%, all right, at the first entry, so you now, while the trend is moving or while the market is moving, you want to start spotting areas to have to take another entry and still continue moving in your favor. All right, so that's another way of scaling in. But I prefer to always take the whole entry at once, and maybe when I'm up times 2, I can close 50% and allow the remaining to run. That's also another way to scaling as well, because there is no guarantee that you would see a second trade confirmation while the trend is rallying up. All right, and you do not want to enter unnecessary trades. So only scaling when your first trade is protected already. All right, when you see that the trade you're having already is protected, maybe you're on break even or the profit you have has been locked in. All right, so market structure remains intact, so you don't want to scale into a losing trade if your floating trade is already in negative on a particular pair. Right, you don't want to start adding more positions, right? That's very, very risky. So scale out is what partial take profit. That's what I do personally, right? So maybe when I get to 2 hour, you can close 70%, or you can close 50%. Then you now leave the remaining to run to maybe 3 hour or 4 hour. You understand? So it's just basically just trying to maximize the energy of your trade. So this increases what expectancy. Then managing winning trades. All right. This let's say you have a couple of trades, they are all going according to your favor, and when it comes to management of trades, some people are not still good at it. We say we're talking about risk and trade management. You need to understand these key areas. So most traders sabotage winners, right? So the first one is some people have fixed take profit. They're always targeting 1 to 3, they're always targeting 1 to 4, always targeting 1 to 2. They're not changing, all right? Whenever they take the trade, they are targeting a specific risk to reward ratio. So for example, TPR 2 are really interference, all right? No break even, nothing. It's either it's stop loss or you need to take profit. So another one which is best for and that one is structure based management. So as you know how structure is moving now, let's say an upper structure have low to high to higher low to higher high, series of higher lows and higher highs. All right. So whenever price breaks a high to form a new high, they have their what they start trailing the market in that way. So whenever market has formed a low and that low has what broken a high, they put their stop loss below that low and start following the trend until the market what intends to what change structure, and they stop that. But through that way, they are able to accumulate a lot of reasonable profit. So this one's what it lets trade pay you, but this requires what emotional discipline. You have to be sharp, right? Because if you are not sharp, sometimes you start thinking it's going to take you out when it was just actually just trying to reverse, right? So you just have to be emotionally sharp and disciplined. So cutting losses early, this one is also very very valid. Let's say you were trading structure, right? And you're trading a bearish structure, and we know that when break of structure in the opposite direction happens, especially with a momentum candle, we are definitely expecting what that structure to change. So imagine you're in a trade like that and you see that type of thing happen, especially when it happened in your stop loss box, like in that area from your what, so you will take profits to stop loss, especially when it happened in that area. Let me say, let me try to get it on. So let's say, right. So let's say this is your, let's say you are buying the market. Let me try to have this. Okay, then this, right? So then the market what comes like this. Let's say you were let's say we're in this trade at this area. Let me say at this area, let me put it here. You're targeting this high, right? Your stop loss was like this. So what market is, market what is supposed to just what come, you get create new low. It's supposed to just come, create a new low, and just what to continue, right? But what market does that? Market does what? Market does not just weak this low, it breaks it significantly, right? And start retracing back. You know, obviously when there's a break, there's expect a retracement. It will happen. I mean, when it start retracing back, that's when you know that once you see this thing happen, just know that what market structure is about to shift to the market is about to change to the opposite structure, to another one. You understand? So is it that you either close your losses at this page before you eat you out, or and if you intend to wait, you can try to see if market will still reverse a little bit to take you back to to break even, so you can just leave that trade, because you know that there's no reason, like, because you see somebody when the market eventually reverses and when they're supposed to take that type of trade out, they now leave it because they're not in profit, right? That means that type of person is not disciplined emotionally. They're happy because they're seeing the profit, and before you know, the market just trying to retrace, and then it dumps, right? And they're out. So that's it. Then so impulse strategy has one rule: if displacement falls quickly, exit. Alright. Strong rejection immediately after entry. Opposite structure break, momentum dies. Alright. These are several reasons why you can leave the market. Right. When you enter and then you see a strong rejection, you do not want to mistake all this for emotional trading decisions, right? You just want, that's why I said there are rules that you set down to keep you in the right track. All right, maybe opposite structure break, like I explained just now, then maybe the momentum just dies. All right, the market is not moving with great candles anymore. You need to start paying attention that is this a sign that the trend is weakening. All right, instead of it allowing you to take your foot tape, you can just cut your losses early, or even better still end in little profit. So advanced traders sometimes cut at 0.5 hour instead of full hour. This improves win rate without increasing risk, right? People think that they have to always use all the risk available for them. Like I'm saying that, okay, per trade or per day, I want to risk 1%. That does not mean that I have to risk all the 1% that they go. That means that the maximum I can risk, right, is 1%. That's where it comes to breaking trades down, right? I can start to take 0.2% here on this trade, take 0.2. You get, if I take 5 trades, risking 0.2%, each is on different of them, all right? Still approximately 1%, okay? So, but be careful. Don't turn this into a fear-based exiting. Like I said, you need to be sharp. So, only cut early when structure invalidates. Now I said structure is very, very, very beautiful. You want to pay very, very good attention to it. Alright, so I think that brings us to the end of intermediate module 5. So I'll see you on the next one.